Good morning, everyone, and welcome again. Well, today we want to firstly say thank you for joining us and thank you for the support you continue to give us. Today we'll be briefly speaking on another important aspect that relates to our business and our finances. So today we'll be discussing another asset category, which is inventory. Many of us sometimes we hear inventory and we don't know what inventories are and what are the criteria that a particular set of commodity or items should contain before we consider them as inventory. So quickly, inventory are basically goods you buy and store up for the purpose of reselling them, or raw materials you buy for the purpose of using them into production. So inventory could be materials that you use into production, or they could be already finished goods that you have bought with the purpose of reselling them. Remember, if you buy items to use in the operation of your business, they are not inventory. Like for instance, you buy cars, so don't you are using them for the daily running of the business, they are not inventory. But if you buy cars with the purpose of selling them, then they could be inventory. So inventory normally they are considered as current assets because, like we said, they can be converted into cash within a very short period of time through the process of transferring ownership, that is selling them to another person in the form of goods. So inventory are normally kept by either a merchandising business that sell already finished goods to probably end users or so, or a manufacturing company. So a manufacturing company or a merchandising company will have an inventory account where they can record goods that are already being produced for the purpose of resale. Additionally, for manufacturing companies, they can have different kinds of inventory. They can have raw material inventory, they can have work in process inventory, and that of finished goods inventory. So these are three different kinds of inventory. Raw material inventory are raw materials they buy to be used in the process of production. Work in process are those goods that are still in the process of being produced, that they have not fully being completed. We consider them work in process and they are inventory for them. And also we have finished goods inventory. Those are goods that have totally finished, only to now be taken to the end user. So we have the three kinds of inventory for manufacturing companies. And merchandising only take into account finished goods inventory because these are goods that are already prepared, waiting to be taken to the end users. So these inventories tab, normally every business, they got three way of calculating the value of inventory. Whether they are finished goods, they are work in process, or they are raw material. We have what we call first in first out method, we have the last in first out, and we also have the weighted average method. So these three methods are used to measure our inventory, take into account our cost of sale, because it is out of the cost of sale that we get to know what we made as a gross margin or gross profit. So to be able to calculate our gross profit, we need to be able to calculate the cost of our inventory, and we can calculate our cost using either the last in first out, the first in first out, or the weighted average method. But for accounting purposes, the last in first out is not advisable these days. So that is something I have a little more detail, but we're going to focus on just inventory. So normally it is quite acceptable to use the first in first out or to use the weighted average method. In the first in first out method says goods that are purchased first should be sold first, and goods that come in last should be the last you sell. And in the weighted average method, whenever you purchase goods of the same class, you add them together and try to get the weighted average and the weighted price for them. In that way, you can be able, at the end of the period, once you are done, you already know the cost of any inventory, you know the cost of the goods you have sold. Exactly. So that's how it is done. Now, for the first in first out method means that if you purchase, for example, maybe you purchase 20 pen first at $10, and later you purchase 5 at let's say $15. The rule is saying if somebody came to buy 23 pen, you should sell the 21st that you bought at $10 before selling additional 3 from the 5 you bought at $15. That's how the rules work. So inventory as a whole is very vital, is very important to the operation of every business. Like I said, it is a current asset that is used to carry on the operation of the business. If it's a merchandising business, it's actually goods we hold to be able to sell to customers within due time. If it is a manufacturing company, it means that we have 3 different kinds of inventory we have based on the operation we are into. We have raw material, meaning that the raw material we intend to use into production. We have work in process, meaning that those goods that have already been halfway produced but not totally completed. And we will have finished goods, meaning that those ones that have already prepared and taken to the finished good warehouse. So as a manufacturing entity, you have 3 different warehouses. You have raw material warehouse, you have work in process warehouse, and you have finished goods warehouse. And there are channels to transfer these goods from each of these category to the next category, which are things we will discuss in some subsequent videos. But we just wanted you to know that this is how you do inventory recognition, and you'll be able to understand that you can use either the weighted average or the last in first out method to do the calculation of your inventory perfectly, to avoid being able to have miscalculation or misinterpretation in your financial records. Thank you very much for following up. Please keep following up for more. Please like, share, comment, follow. Thank you.